This week, the market was flying blind. Again. In the EU, a 10% pop, a 39% collapse in Tesla, and a 248% rise in BYD. They're distracted by the symptom. This is the real story. This is the shadow contagion. Our reporting hasn't been isolated stories. They were proof of this hidden system breaking down. But the real exposé? One simple question. Who's funding them? The shadow contagion isn't just shadow banks. It's the hidden off-books exposure of the real banks. Stop flying blind and read the exposé.
Welcome, welcome, welcome. This is your host, Josh Logan, and you are listening to Confessions of an Insider. This is the place where automotive strategy meets market reality, the ASMR edition. This week, we pull all the threads together on our core theme, flying blind. We're going to show how the market is being willfully distracted by surface-level data, causing it to completely miss the profound systemic rot that's happening just underneath the foundation of the auto finance industry. We will start by analyzing the distraction, this week's European auto report, and then pivot to the real story. They are all blind to it. The NDFI shadow contagion. Let's start with the distraction.
Welcome to the deep dive. Okay, let's jump straight in. We're looking at the latest European auto market figures. And, well, the headline number looks pretty amazing, actually. A solid 10% jump in EU registrations for September 2025. You'd think, wow, healthy recovery, right? But our mission today is to show you why that headline might be, well, a dangerous mirage. If you just look at that 10%, you're missing some serious systemic rot underneath.
That's exactly it, a dangerous mirage, because the market seems to be, ignoring some really foundational weaknesses. And there's this huge, almost violent corporate reshuffling happening right under the surface.
Completely hidden by that one monthly number.
Right. So we really need to look past just September. We need to see the year-to-date, the YTD totals to get the real picture.
Okay, so let's unpack that illusion then. That 10% jump for the month, it feels like a boom. But you zoom out, you look at the whole year so far, January to September. What's the actual growth for the EU market overall?
It's almost flat. The total YTD market is up just barely positive, plus 0.9%.
0.9%, okay.
Yeah. And look, some people might say, oh, well, even tiny growth is good with inflation and, all the supply chain stuff we've had. But that tiny number, it hides something really critical. The engine of the European economy, it's actually sputtering.
And the numbers really show that foundational weakness, don't they? We're talking the big guys, the core economies. Germany, year-to-date, shrinking at minus 0.3%. France, down a pretty serious minus 6.3%. Italy's contracting too, minus 2.9%. I mean, these major markets are clearly in the red.
Precisely. Yeah, those three, they basically dictate the continent's economic health, right? And they are struggling. The only reason the total EU number is even positive is because of, well, it's a statistical outlier, really. There's this localized surge happening in Spain. Spain's propping the whole thing up with a massive plus 14.8% YTD growth.
Wow.
So yeah, this isn't some healthy continent-wide recovery. It's serious weakness just being masked by geography and, frankly, statistical quirks.
Right, and that weakness, that geographic split, it's mirrored in this huge structural shift in what people are actually buying, this great powertrain divide, as we're calling it. This shows where consumers are really putting their money. And wow, it shows a collapse in traditional tech.
Oh, it's undeniable. It's like a systemic flight from the pure internal combustion engine, from ICE. If you combine pure petrol and pure diesel, their market share, it's just plummeted. It was nearly 47% last year now, just 37%.
37. From almost half the market down to just over a third.
Exactly. And diesel specifically, it's in absolute free fall. It dropped from 12.4% share down to only 9.3%. Consumers are just, well, they're abandoning these traditional engines like crazy.
And this is the really fascinating part, they aren't rushing headlong into the all-electric future just yet, are they? There's a hedge. They're running from ICE, sure, but they seem to want, like, a safety net.
They absolutely do, yeah. Hybrids, the HEVs, they're now the dominant force. It's the single largest segment now.
Really? Bigger than petrol?
Oh, yeah. Consumers are clearly choosing the reliability, the range assurance of hybrid tech. Hybrids now command 34.7% of the year-to-date market share. It's the new default choice, pretty clearly. Battery electric vehicles, BEVs, I mean, they're growing steadily, sure, but they still only hold about 16.1% share. So the big structural shift, it's landing right in the hybrid column first.
Okay, so weak core markets, a flight from ICE mainly towards hybrids. And this is where the corporate story gets messy, right? Where the headline growth completely hides this massive reorganization.
Yeah.
And the most shocking number here, it's the collapse of the former BEV king.
Yeah, the Tesla story in Europe this year is just, it's huge. Year to date, their sales have cratered down a stunning minus 38.7%.
Minus 38%.
Yeah, they've lost, over 70,000 units compared to last year? This isn't just a blip. It feels like what happens when, you get way more competition hitting an older product line. They've cut prices, but it hasn't really worked to keep that dominance.
So while Tesla's imploding,
yeah,
who's filling that massive gap? Who's taking that share?
China. Absolutely. While Tesla's falling, China's BYD, this global giant in electric vehicles, they have just exploded onto the European scene. They've surged an incredible plus 248% year to date.
248%? Wow.
Yeah, they're going from almost nowhere to being a major force. Basically, just absorbing the market share that Tesla's shedding. It's like an invasion.
And the old guard. The legacy giants like VW Group, where are they in all this chaos?
They're kind of just treading water, honestly. VW Group managed modest growth, about plus 4.8%, which, okay, technically that's better than the flat market overall, but they aren't driving the change, The real battle seems to be between this collapsing pioneer, Tesla, and this incredibly fast-moving invading force from China.
Okay, so let's synthesize this. What does this really mean for you listening? First takeaway. Don't get fooled by that shiny 10% monthly number. The European market is structurally weak underneath, core economies are shrinking, and consumers are fleeing traditional engines, mostly jumping into hybrids for now.
Exactly. And the second big takeaway, the corporate landscape is undergoing this complete, almost violent reorganization. It's being driven by Tesla's massive collapse, which is just opening the door wide for this huge push from Chinese manufacturers like BYD.
So maybe the question isn't really, is the market up 10% or 1%? That kind of misses the point now.
Right. I think the real question, the thing to really mull over is this. If this structural weakness continues and this flight to hybrids keeps going, which legacy car maker, maybe even which national economy is going to be the next one to buckle? Who gets left behind in this complete and probably permanent reorganization? That feels like the bigger question now.
So a headline number that shows a market is basically flat, up less than 1%. Most analysts would see that, shrug, and move on. But as we just heard, that tepid headline is a dangerous mirage. It's completely masking the real story. A chaotic, brutal war for market share, where Tesla is in an absolute freefall, down almost 39%. And Chinese-backed BYD is exploding, up nearly 250%. This is the very definition of flying blind. The market is cheering a meaningless headline, while completely ignoring the structural rot and the invasion happening right under their noses. And that brings us to our main event. Because this exact same dynamic, a dangerous distraction hiding a systemic crisis, is happening right here at home on a much, much larger scale.
Welcome to the Deep Dive. Today, our mission is to give you a really clear view on why the market seems to be flying blind right now. We've gathered sources connecting some pretty alarming signals in the auto industry to this huge hidden risk. We're calling it the shadow contagion.
Yeah.
And the scale we're talking about here is, frankly, staggering. We're looking at $2.2 trillion in loan commitments.
Wow.
Yeah, linking the big regulated banks, directly to these unregulated shadow banks. And the key thing for you, the listener, is that the first signs, they're not theoretical anymore. They're actually showing up in consumer default data now.
Okay, so let's unpack these red flags.
Yeah.
The ones Wall Street seems to be actively ignoring. Starting with the auto market, it's giving off really conflicting signals.
It really is.
You see headlines cheering, a 10% rise in European car registrations. Looks like a recovery.
It's a total illusion, structurally speaking. You look past that headline number, and the core markets, Germany, France, Italy, they're actually shrinking.
Yeah. And get this for an indicator. Tesla, down 39% year to date over there. Collapsing.
Minus 39.
While China's BYD has just exploded, up 248%. The shift is huge, the rot is real, and the market just, looked the other way.
Okay, so global weakness is clear beneath the surface, but how does this connect to, say, the U.S. consumer? Do we see it here?
We don't have to guess. Ford's Q3 earnings basically spelled it out. Analysts cheered the revenue beat, you know.
Right, the headline number again?
Exactly. But buried in the fine print, Ford credits provision for expected loan losses. That's the money they set aside because they know people won't pay.
Okay.
It exploded. Went from $323 million in Q2 up to $477 million in Q3.
$477 million, that's nearly a 50% jump.
In 3 months. In 3 months. That's Ford explicitly bracing for a wave of consumer defaults. It's coming.
All right, so we've got the symptoms laid out. Let's diagnose this. The shadow contagion. What is the mechanism connecting these, like, auto loan losses to the whole system?
So these symptoms, they trace back to what are called NDFIs, non-depository financial institutions.
Shadow banks.
Shadow banks, exactly. Think of them as the high-risk lenders, the subprime auto guys, maybe?
Yeah.
Operating outside the standard banking rules,
Right.
which lets them pile on huge amounts of leverage without the usual oversight.
Right.
The shadow contagion is basically what happens when these lenders fail, and the major banks that fund them are forced to absorb those losses.
And we're already seeing failures. You mentioned Tricolor and Primaland.
Yes, specific cases prove the infection is spreading. Tricolor, a subprime auto lender, its failure showed that huge banks, Chase, Barclays, Fifth Third, had over $600 million directly exposed, just to that one entity.
$600 million.
But Primaland's collapse, maybe even more significant. This wasn't fraud. This was a lender to the lenders, crushed by pure macro pressure. The great squeeze, as our sources called it.
Right.
It proved the whole high-risk lending infrastructure is starting to break, not just, a few bad actors.
Wait, okay. Tricolor, Primaland. These are hundreds of millions. Still sounds containable, maybe? How do we get from that to a systemic multi-trillion-dollar problem? Where's the big connection?
That's the critical question. They matter because they're taking the initial risk, yes, but their fuel comes from the traditional banking system. And the Federal Reserve, they did a study in 2023, and their findings, that's the bombshell. They found the 31 largest U.S. banks, they're systemically important ones.
The big ones.
The really big ones. They have a staggering $2.2 trillion in loan commitments just to this NDFI shadow bank sector.
2.2 trillion. Let's just sit with that number for a second. That's not just big. It's almost unimaginable exposure to the riskiest part of finance.
It's enormous.
So when you put it all together, that $477 million Ford provision, that consumer tremor we talked about, it connects directly back to this $2.2 trillion systemic liability. The auto market isn't the problem itself. It's just the visible arena where this deeper rot is finally bubbling up.
That's exactly it. We've seen the blind spots ignoring the structural collapse in sales, Ford's huge default warning.
Right.
We've identified the cause, these NDFI failures like Tricolor and Primaland, showing the contagion spreading.
So here's the final thought for you, our listener. If the failure of just a couple of these shadow lenders is enough to make Ford brace for almost $500 billion in consumer defaults,
Yeah.
what does that documented $2.2 trillion exposure truly mean for the stability of the entire traditional banking system? That's the question you should really be thinking about right now.
That is the real crisis. Not a 0.9% change in sales, but a $2.2 trillion shadow banking system that is beginning to unravel, and as we exposed, has its tentacles deep inside the too big to fail banks. The collapses of Tricolor and First Brands weren't the end of the story. They were the beginning. They were the cockroaches that proved the rot was real. And what we've uncovered is the source of that rot. A vast, unregulated network of non-bank lenders that are now failing, leaving the regulated banks who were feeding them cash dangerously exposed. The market is flying blind to this. They're treating these as isolated events. But as we've already proven with our domino effect investigations, this is not a theory. This is a crisis that is already in motion.
Okay, let's dive into the auto finance world today. There's been a lot of turbulence, shaking things up.
Yeah, quite a bit.
We've seen the headlines, right? The alleged fraud at Tricolor, billions involved.
Yeah.
Then First Brands, that whole implosion. Big, noisy failures.
Definitely headline-grabbing stuff.
Yeah,
Scandals.
Exactly. But today, we're looking at something different, something quieter, maybe. The Chapter 11 filing of Primaland Capital Partners.
Right.
And our mission here is to figure out why this failure, specifically, feels uniquely terrifying. Because it doesn't look like fraud. It seems more like a sober surrender to just overwhelming market forces.
It's a tragic scenario, really.
Yeah, it suggests this great squeeze we talk about is now breaking apparently honest players.
Yeah.
That the pressure is truly systemic.
And to really get why this is so significant, you need to understand PrimaLend's role. They weren't a household name, not lending directly to consumers. They were behind the scenes, critical infrastructure, the lender to the lenders, essentially.
Not to the lenders.
Yeah.
Meaning
they provided the financial lifeblood, the capital, for thousands of those buy here, pay here dealerships. The BHPH guys focused on subprime auto loans.
Ah, okay. So they funded the dealers who then lend to car buyers.
Exactly. And we're talking scale here. They listed $286.1 million in debt. They were recently doing something like $45 million in monthly loan volume.
Wow. Okay, so a major player in that specific market.
A pillar. When a company like that stops operating, it's like turning off the oxygen for a huge chunk of the used car market almost instantly.
And that distinction you made earlier is this being an economic failure, not alleged fraud like Tricolor. That's key here.
Absolutely crucial. Tricolor is one kind of story, potentially about bad actors. PrimaLend seems to be a story of just simple, brutal economics.
But wait, if inflation and high rates are hitting everyone, why PrimaLend? What made them crumble? Was there something specific about how they were set up?
Well, that's what the bankruptcy filing from the Texas Northern District makes pretty clear. They were caught in this impossible vice, 3 big macroeconomic factors hitting all at once.
Okay, what were they?
First, just crushing inflation. That squeezed the end consumer, the person buying the car at the BHPH lot.
Making it harder to pay the car loan.
Right. People prioritize rent, food. So defaults on those BHPH loans started ticking up.
Okay, factor 1. Consumer stress.
Factor 2, high interest rates. The Fed hikes dramatically increased PrimaLend's own cost of borrowing money, their cost of capital.
So the money they needed to lend out got more expensive for them.
Skyrocketed. And the problem was their income often came from existing loans with fixed rates. So their expenses went way up, but their revenue didn't keep pace. They were essentially bleeding cash just servicing their own debt. Destroyed their margins.
A classic margin squeeze. Okay, what's the third factor?
Post-pandemic market volatility. Specifically, the collapse in used car values. That was the final nail.
Because the cars are the collateral for the loans PrimaLend ultimately backed.
Exactly. Think about it. A car bought maybe 2 years ago for, say, $18,000 might only be worth $10,000 now. But the loan balance could still be $15,000. If the borrower defaults, the lender instantly loses thousands on repossession. That drop in value just undermined the security of their whole loan portfolio.
Wow. So higher defaults, higher borrowing costs, and collapsing collateral value all at once.
A perfect storm. Really unavoidable, it seems.
And what tells the financial world this was, an honest collapse, not something shady?
The creditor's reaction is a big signal. Reports say PrimaLend's major creditors are actually working with them to secure debtor-in-possession financing, DIP financing.
Okay, what does that signal mean?
It means the institutions owed money likely believe the underlying business was basically sound, but was genuinely crushed by these external economic forces. They wouldn't throw good money after bad in a fraud situation. They want to salvage what they can because they see it as a legitimate casualty of the economy.
Okay, connecting the dots then, what's the big implication here?
It's huge. If the companies providing the capital to the dealers, the financial backbone, are failing because of market pressure,
then the whole foundation of that subprime market is shaky.
Dangerously unstable. It proves the pressure isn't isolated incidents like alleged fraud at one operator. It's systemic. It's moved into the financial plumbing itself.
So let's bring this back to you, the listener. Why does this matter more, maybe, than a scandal?
Well, a scandal, you can sort of isolate it, blame bad actors. It's contained in a way.
Right, clean it up and move on.
But a failure like PrimaLend, driven by pure economic pressure that's hitting everyone, that's a sign of a fundamental crisis. It means the contagion is spreading from maybe individual operators to the financial system supporting them.
That feels much more worrying.
It's a much deeper indictment of the market's overall health. It signals that these macroeconomic forces, inflation, high rates, the squeezed consumer might now be fatal even for businesses that were, playing by the rules, well-structured businesses.
Which leaves us with a really unsettling question for you to think about. We've seen Tricolor go down, allegedly due to bad behavior. Now PrimaLend is down, seemingly due to legitimate economic reality. Who's next? The vulnerability seems to be climbing the ladder.
And that is the smoking gun. The PrimaLend collapse. A collapse with no fraud. Just pure, undeniable macroeconomic pressure. Let's tie it all together. The market is flying blind. They are distracted by tepid, surface-level data like the European sales report. They are completely missing the real story, the shadow contagion in the NDFI system, which our domino effect investigation into Primalend proves is already claiming even the honest players. The Great Squeeze has created a crisis that is now self-sustaining. The dominoes are falling, and the market is still pretending it's just the win. That's our show. For the full in-depth analysis, all articles, and any data, tune into theloganzone.com. Stay sharp, stay informed, and stay tuned. I'll see you next week.